And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. It's the second best day of the week, of course, Thursday, as we get ready to wrap up the week. And Michael Leibowitz joined this morning to talk a little bit about Jackson Hole, which is this whole weekend. It's Jackson Hole Summit weekend. We'll hear from Jerome Powell, what he's going to say. Also talk a little bit about recent commentary from the likes of Nick Timrose, talking about, higher interest rates potentially as the Fed's talking about that. Well, we'll get into all that this morning. Of course, we can't bypass the big news last night. NVDIA reporting earnings, not surprising, blowing the doors really kind of off their earnings announcement. And again, stocks going to be trading up this morning, about 6-7% this morning at the open, maybe a little bit more. Interestingly enough, though, and I thought this was an interesting note, they said that their sales are going to grow by 170% annualized. Okay? Now, that's take 170%, divide that by 4, right? So that's how you get annualized growth. So next quarter will be 1/4 of 170%. Last quarter, they grew sales by 50%, which is 200% annualized. So the growth rate is slowing, but the numbers are big, right? This is the whole thing. So stock will be up this morning. Importantly, there's been, I'll spit this out. NVIDIA had kind of chopped sideways here for about a month or so. Sold off just a little bit, no big deal here, but got very oversold on a MACD basis. You're getting a buy signal really yesterday with that bit of a rally pre-earnings. The rally today, which will now take it above this double top that it's been building here over the course of the last couple of months, is now going to complete that consolidation phase of NVIDIA. So now you've got a nice strong buy signal coinciding with the double top breakout. This sets the stock to potentially move up to between 550 and 600. So, there's a tradable opportunity here, obviously. The company's very expensive still, no doubt about that. It's now a larger market cap than JP Morgan. So, and it's closely closing into a larger market cap than the entire DAX index. So again, very expensive, on its way to being the second largest company by market cap in the S&P 500. It's if it reaches its projected price targets by Wall Street, it will be larger than Microsoft. So just goes to tell you kind of what's going on there with earnings. But again, technically everything looks fine. Again, you get a nice little breakout here, tradable opportunity. And again, where the upside from this is who knows, right? I mean, it's a function of, momentum in markets and this AI chase. Valuations still remain very expensive. You're still trading at 30, 40 times price to sales. But sales and earnings are growing, no doubt about that. So again, just something to kind of pay attention to. This is going to be the driver for the market today. NASDAQ this morning looking to be up about 1.5%. Really kind of as all tech stocks are going to rally today. Again, this has kind of been the movement over the last few days. It's been the mega caps back in lead. We'd seen a kind of a brief rotation in the markets into kind of some of the other areas of the markets, but really over the last few days, it's really back to that tech chase. And again, we're seeing a lot of money flow into those mega cap names. That's driving markets. Importantly, as we kind of look at, kind of where markets are, we got to talk about interest rates, because interest rates are a function of revenue growth and economic growth over time. So if interest rates continue to remain elevated, that is going to impact what is happening in terms of the economy, which is going to ultimately impact earnings. Expectation right now by Wall Street for earnings growth is still very strong. Now, interestingly enough, Wall Street has been tailoring back their earnings estimates for 2024. So the end of 2024, we were at $228 a share. That's down to $222. So we're now starting to ratchet down those longer end projections for earnings. They're still strong here, no doubt about that, but they are starting to come down. So we're already starting to see very early on these very elevated expectations for earnings into 2024 starting to come back down down to earth here a little bit. And again, if we start to see further economic weakness or a resurgence of economic weakness, that's going to bring those down more. Yesterday, the S&P Global PMI Index was out, and that showed a reversion now back into contraction for services. So again, depending on what economic index you're looking at, it's everybody's got a different opinion, but looking at the data, there's still this underlying churn within the economy of this battle between some pockets of strength, some pockets of weakness, and again, it's just kind of hard to make it out. New home sales, as an example, 34% increase over last year, so people are back to buying homes. That's a positive for the economy, but at the same time, you've got a lot of other areas of the economy showing weakness. So again, this is going to be the battle we have to deal with over the course of the next really few months as we head into the end of the year. But we'll get into all that. Here's what you need to know before the bell this morning. Markets are rallying right now. Again, we talked about on Tuesday, markets are due for a rally. We're very oversold here, and we were expecting this rally to occur. So this morning, the markets are going to battle with this very close kind of cluster of resistance. It's the 50-day and the 20-day sitting right on top of each other. If markets can pierce through that, so we got to get above 4440 on the S&P 500. If we can get above 4440 on the S&P 500, that's going to clear the way for a retest of the recent highs that we had back in July. Doesn't necessarily mean that the correction that we're in right now, or this kind of period of seasonal weakness, is over. But again, this rally that we're having, that we've been talking about here, is now coming into play. The MACD is getting ready to cross back into a buy signal. Depending on the strength of the rally today, that could get us very close to triggering that buy signal on the S&P. And again, we're not overbought yet. So again, as we kind of take a look where the market is, the market kind of loaded up for this rally. We got oversold on a relative strength basis. The MACD kind of completed a normal retracement of its normal oscillation during a bull market. So again, starting to see that turn back into a buy signal. That suggests that we should get a move here higher in prices, at least in the short term. Again, we still have some seasonal weakness ahead of us. So again, could just be a bit of chop here, have a nice rally for a day or two, get above the 50-day moving average. The NASDAQ will actually get above the 50-day moving average today. But then we get above the 50-day and then kind of chop along sideways along that moving average for a couple of weeks, and then that'll potentially set us up for that October, November, December rally into end of the year, which should theoretically take us to a new high for this year. Not necessarily all-time highs, but potentially new highs for this year. Again, lots of performance chasing that will happen in the year. See a lot of people pile into stocks trying to catch up with markets. And again, there's been a big bifurcation continues between, you take a look at what's going on with the S&P 500. As an example, big bifurcation between that and what's happening in other indexes. I mean, if you take a look at small cap, mid cap, just continually not really making much of an advance here. In fact, if you take, going back and kind of looking at small and mid cap over a longer period time frame, just really has not participated much at all. So really a very concentrated rally in the overall markets. So again, kind of keep your concentration in large caps for now because, well, that's what's working. That's where money's going. So we just have to stay concentrated there for right now. Again, technology stocks overvalued relative to the rest of the markets. No surprise there. But again, it's passive flows still pushing a lot of this into the markets. Again, NVIDIA is going to be the big story for the day. That's what will be driving markets. And again, that's what the focus will be on the entire day. Will just simply be that. But we'll get into other stuff as we go. Again, when we come back, these are the things that we want to look at. But again, for right now, maintain your allocations, maintain your risk controls. We're still in 2 months of kind of this seasonal weakness. And again, we'll get a little bit better look once we start to get into a buy signal mode and then potentially start to push back up towards all-time highs, towards this year's highs in the S&P 500. That's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Leibowitz, talk a little bit about the Federal Reserve, Jackson Hole, what to expect. And of course, these ideas about higher interest rates potentially from here. Could that be the case? We'll talk about all that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. I'm Lance Roberts, Michael Leibowitz joining me as well, talking a little bit about the Jackson Hole Summit. It's the annual mountain retreat in Jackson Hole, Wyoming, where the rich and powerful central bankers all join together, and they have this big confab to basically act like Pinky and the Brain and figure out how they're going to take over the world this year. So every year it's the same. It's the same conference every year. And again, we'll get a lot of speeches coming out of this. We've had speeches over the last couple of days, going into this conference. James Bullard out with the Wall Street Journal talking about how recession fears have been blown out of the water. Of course, James Bullard was one of the longer tenured 12 regional Federal Reserve banks, and he had stepped down last month. He thinks the U.S. economy, I'm going to just quote to you from the Wall Street Journal this morning, he thinks the U.S. economy faces new risk of stronger growth that could require higher interest rates to keep up the fight against inflation in the months ahead. He said Fed officials have raised interest rates by a quarter point. He said that he thought he would need to lift them again. He, being Jerome Powell, will need to lift them again this fall. The Fed might have to raise rates even more if the recent economic acceleration continues. And there's certainly some, signs that the economy's doing just fine. I mean, we've seen services, the ICM Services Index had ticked up recently. Again, as I noted this morning, new home sales yesterday came in up 34% year over year. Existing home sales still kind of tenuous here because, again, if I'm in a house and I've got a 3% mortgage, it's tough for me to sell my house and go to a 7% mortgage and buy a new house. But again, there's people that are doing it. But on the new home front, nothing seems to really be slowing people down that much. We've seen some declination in housing, but not to the degree that many of the bears last year were certainly predicting. You're talking about another housing crash, and it's going to be another 2008. Certainly hasn't been the case so far. Doesn't mean it won't, right? I'm not saying that none of this has happened. It just hasn't happened yet. So this is kind of the baseline for James Bullard view is that, economic growth is still strong. Labor markets, the unemployment rate still seems to be okay at this point. Labor still keeps going along. They did do their first annual revisions yesterday to the data that revised down the employment data by about 300,000 jobs. Not a huge number, but job growth has been weaker than expected by a small margin. But importantly, the trend is negative. The trend of job growth is declining, and that's something to certainly pay attention to. So again, it's a real mixed bag here. This is the big debate, right? This is the big thing that's going on is does the Fed need to hike rates more? Have they gone too far? That's going to be the big debate this weekend at Jackson Hole. Mike, so what are your kind of initial thinkings that we'll hear from Jerome Powell over the weekend?
I think we're going to, excuse me, I think we're going to hear much of the same. Higher for longer. We're not even thinking about cutting rates. That his number one goal is to stamp out inflation. And, you know, he probably doesn't want to raise rates anymore. He's probably scared of what they've done already. There's no gauge to tell them if they've done too much. It's kind of like if you're out drinking one night, there's not a hangover gauge that tells you how bad the hangover is going to be the next day. So, you know, Jerome Powell knows they've had quite a few drinks and still feels fine. And the question is he willing to keep going? And he, you know, every time he talks, he mentions lag effects. So he clearly understands the risks. But the other risk is that they don't stamp out inflation. And I think given the size of the fiscal deficits that, you know, the debt outstanding and what they're expecting on the fiscal deficit side, he has no choice but to stamp out inflation. So he's going to be the same Jerome Powell that we've seen, pretty hawkish. We may raise rates one or two more times. We're not even thinking about cutting rates. And, you know, I think the big question is, will he address what they call the neutral rate? And I think that's kind of Nick Timrose from the Wall Street Journal brought this up. And I think that's going to be a point of debate. And basically what that is the rate at which interest rates are neutral. They neither restrict the economy nor stimulate it. And traditionally that was thought to be around 2%. It's kind of a made up rate. You can't really calculate it. But 2% was kind of that rate. And now there's a couple Fed members thinking it should be higher. And what they're basically saying is that the economic growth trajectory in this country is now higher. So, you know, as we exit the pandemic, the growth rate all of a sudden will start increasing, having decreased for the last 40 years. You know, we can debate that all day, but I think where does Jerome Powell stand on this? And based on prior comments, and some of those comments are in the Wall Street Journal article, he's not in favor of that.
Well, I think you've got to, you know, really put that into context, though, Mike, because every year from 2008 to 2013, the Federal Reserve always came out with their, you know, so since 2011, that was when they started this kind of quarterly projections.
Right.
And every quarter, what they do is they publish their projections on economic growth, inflation, and employment. And ever since 2011, and this was under Ben Bernanke when, you know, he was just coming out of the financial crisis, he says, hey, it'll be a great idea. Let's publish this kind of our views internally about what's going on. So I started tracking these, and I track these every quarter. So every quarter they publish these, I mark them down, and I take the median of the range, and I just put that into a spreadsheet. And every year since 2011, they have always expected initially, at the beginning of the year in particular, that economic growth was going to finally break out of the trend. We're going to be above 2%. We're going to grow at 3 or 4% this year. It's going to be awesome. By the end of the year, we're at 2% or less. And this is always the problem, is they're always expecting stronger growth, and yet we don't get stronger growth. And this is kind of the problem with Nick Timrose's article, which is this idea that somehow magically we're now going to break out of the bonds of debts and deficits and start creating stronger rates of economic growth because, and only because, looking in the rearview mirror, we've had stronger growth because of a massive flood of liquidity from the government that will no longer exist at some point in the future with restrictive interest rates. So, you know, the math doesn't support what they're hoping for. But again, they always hope for this and they never get it.
Right. Nothing, you know, I mean, this is the heart of the bond market question right now. Are you a bond bull or bond bear? The bond bulls think that the last 40 years of history and every driver, every factor that drove economic growth lower for the last 40 years is still intact. The bond bears think that something changed with COVID, with the pandemic. and that all of a sudden economic growth will increase. And, from my seat, at the end of the day, what the government did, what corporations did was add more debt. More debt, that government debt will actually create negative economic growth down the road. Today, it creates positive growth as they spend it, but then paying it back and taking that capital away from the market where it can be, in theory, productively invested, has a negative effect on growth. So, there are reasons to think that growth can increase, but there's still more reasons, including demographics, which just continually will worsen here, to think that the trends of the last 40 years are intact. And, it is a downward sloping line if you kind of graph economic growth, but really you see it in tiers. And after each recession, you have a lower level of economic growth than the prior recession. And that's because during each recession, there's a surge in stimulus spending. The Fed takes more actions than it did the prior time to keep the boat afloat. And that's the bet this time is, this is, the pandemic response, is a relatively light recession, but the fiscal response and monetary response was massive, much more than we saw in 2008 and 2000. So, the question in my mind is what's really changed? And, until I hear some good excuses that this, that, and the other changed, you have to think that the neutral rate is, if anything, less than where it was, and that at the end of the day, interest rates are going to be below where they were, or at least where they were before the pandemic.
Yeah. And again, just the question is going to be, what causes us to get there? And again, as we take a look at, the economic data, and again, you take a look at the trend of employment growth, yeah, we're still adding jobs right now, but that trend of growth is slowing. And, this is the one thing that I think a lot of economists kind of miss is they always look at the number and they say, okay, well, here's the number. The number is, a good example of this is the ISM index. As an example. So services or manufacturing doesn't matter. So at 55, we're in expansion. At 54, we're in expansion. At 53, we're in expansion. At 52, we're in expansion. At 51, we're expansion. At 50, we're now worrying about a contraction. Well, it's been declining for 5 months in a row. So, the economy's been contracting, but economists look at it as like, oh, well, you're in expansion or contraction, and it's this break point to where all of a sudden everything changes. But, what we're seeing in the economic data is we're certainly seeing economic contraction and even in employment, which should give some concern to the Federal Reserve that they've probably tightened enough at this point, particularly with these latest revisions lower. So, at least Jerome Powell's got that to start focusing on, even though he's still worrying about inflation. But I think you've got to take a look at a longer-term picture of the trend of the data, which certainly, whether it's leading economic indicators or consumer confidence or a variety of others, it's still the overall trend remains negative and the outlook remains negative. And I think that's going to be the bigger overriding issue potentially for the bond market going forward. We'll talk about interest rates in the bond market when we come back. It's been a big concern this year. Interest rates have to go to the moon now, but is that really the case? We'll talk about that when we come back from the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife loves to watch scary movies. We're watching this one this weekend and lights are off and we're watching the scary movie, and this one scene where, that somebody's just about to get slashed, and this very tense moment, all of a sudden we hear this noise. Boom!
The Real Investment Show podcast.
Both of us just go jumping out of our seats, and the dogs start barking, and they run over to the fireplace. I have a raccoon prisoner in my house right now that I'm holding for ransom. I'm waiting for the parents to show up.
The Real Investment Show podcast. Same show, your schedule.
The raccoon is sitting on top of the flue, and opened to see what was in there, and I saw a little raccoon hand stick over the edge. I was like, nope, you're staying in there.
At realinvestmentadvice.com.
I can only imagine open that flue. That raccoon comes flying out into my living room with two dogs and my wife. This is not going to work out well for the raccoon or me, I have a feeling.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So again, talking a little bit about Jackson Hole, of course, this big meeting. This is the big confab they have every year, and we'll have a speech by Jerome Powell. And remember, this time last year, markets were rallying very strongly and into the month of August, and the hopes were the Fed was going to start talking about cutting rates. And Jerome Powell tore up his speech that he was going to give 15 minutes before his actual speech time, wrote a new one that basically just said, nope, we're not cutting rates. And then the market sold off into October, set new lows for the year, and that was the ultimate bottom for the market. But this is where we are again. So a year later, here we are again. The markets are kind of hoping for the Fed to say something positive, like, hey, we're done hiking rates. We're potentially looking at cutting rates at some point. That's what the market is really kind of hoping for. Which has been the case for the last year, is that, each time we head into a Fed meeting, it's always like, is this the time? Is this the time that, it's going to be the last Fed rate hike? And now we can start talking about rate cuts. And even projections now are still for 2024 that the Fed will be cutting rates next year. And of course, that would be in response to economic weakness, declining inflation, potentially inflation falling to the point that the Fed becomes concerned about deflation, which is a bigger issue for them than inflation. And so that would lead the Fed to start cutting rates and potentially stopping quantitative tightening, at least, for a moment. Or, potentially some other type of crisis shows up. You have a resurgence of the banking crisis as interest rates, remain elevated. That continues to weigh on collateral for banks. So do we have another rash of bank problems coming later this year or first part of next year that's going to cause the Fed to reverse course? And this has been the big driver underneath the markets, is this hope for this return of liquidity. But, interest rates have been, remained high. We were about 3.7%, last month. We're a little over 4 now. And, every time we get around 4%, we have lots of, bond gurus come out. It's like, oh, see, we're at 4. Now we're going to 6. And, the problem still becomes is that, we have a debt-driven economy. So the higher interest rates go, the bigger the break that is on the economy because of all the debt. So again, the big concern has been as of late is that interest rates can only go up from here. Lots of people coming out to talk about the bond bears have been just all over the place. But just fundamentally, mathematically, is that really the case? And again, this kind of goes back to, I wanted to dig a little bit deeper into Nick Timros's article, talking about that and kind of his initial view in his article that he wrote last week about potentially higher interest rates. And this has been some of the talk from, and basically he's just, kind of regurgitating some of the conversations from guys like Bullard, who were talking about stronger economic growth, increased productivity. And since we're going to have this increased productivity in the economy, that's going to lead to, higher rates of economic growth. And of course, the thesis behind this increased productivity, of course, is artificial intelligence. It's going to be the new productivity boost within the economy. And, so is this the first time we've seen this? Has there ever been a period in history where we had some new invention that came along that was going to dramatically change the productivity of Americans? It's going to make everybody more productive. We're going to produce more. And if we're going to produce more, that means that we're working, right? So how does the economy work real quick? You have to produce first in order to consume, right? You got to go to work, you got to produce something, get a paycheck, then you can go home and buy stuff. So so the question is, have we ever had this innovation prior to AI that was supposed to lead to massive productivity boost that would lead to stronger economic growth? And the question is, did it? Did that actually occur? Mike, did that ever happen?
The World Wide Web. Right? That was 20 years ago. We had this massive invention, so to speak, this new thing that will make us so much more productive. Did it make us more productive? In many ways, absolutely. Mm-hmm. Our jobs are much easier today. It's much easier to get information, to buy things, to do things, research, you name it, right? It's been productive. The productivity growth rate in this country has continued to slip for the last 20 years after the World Wide Web became a big deal, right? So, why is that? Well, first of all, a lot of jobs have been lost because of the web. They've been replaced. We've also had robotics, which are another one that you're replacing. You're putting people out of work. And, I think equally important is that on its own, the internet probably did increase productivity in this country, but all we did was counter it with massive levels of debt used for non-productive purposes, and used largely for non-productive purposes, which just further weighs on growth. Lance, on productivity. Lance, we can also just look at AI. AI is not new. We've all been using Google Maps, Waze, all logistics companies. There's many uses of AI that have been out there for. How long have we been using Google Maps and Waze?
10 years.
6, 7 years?
Yeah.
At least. And they've been used by the airline companies, train companies, well longer than that. So where's the productivity growth from AI? We should have seen it already. And again, productivity growth just continues to slip. And, again, why is that? Well, look at what the government did in 2020 and 2021. They issued a massive amount of debt, and all government debt basically boosts the economy at first and weighs on the economy second. So again, did they completely offset, more than offset AI? Will they? And, in our minds, there's no reason to think that the government won't keep spending. That's what they do. That's, those trends are pretty dependable. They want to get elected. And then the other side of it is demographics. We're aging. We're not creating new families at the rate we used to.
Right.
And so is China, so is Japan, so is, a good part of the developed world. We're aging. So we have older people that are more dependent on the economy, basically weighing on the economy, and less new people coming into the economy to support it.
Right.
So, the combination of debt and demographics appears and has been for the last 20 plus years to offsetting any kind of technological progress that we've been making.
Right. And I think there's a bigger factor with AI, which is even potentially more insidious towards productivity than what we saw with the internet. And again, it's interesting. My dad, when I was growing up back in the early 70s, my dad, this is when robotics were really first starting to come in, and we were replacing welding machines or welders at auto plants with these robotic welding machines, et cetera. And my dad was like, well, eventually robots are going to take away my job. And it took about 20 years, but a robot did actually take his job at work where he managed a bursting warehouse. And so they didn't really need him more because the robot would do all do everything he was doing. So he predicted this was going to be the case, and it just took a while to get there. But the difference with AI versus just the internet is the internet's great, right? We can go online, we can order stuff, and we've certainly changed the way that we work and the way that we do things because of the internet. We developed whole new industries like Uber, Grubhub and Uber Eats and these type of things, which are low wage paying jobs. But we did create those jobs in that area because of our ability to order stuff on the internet and have it delivered to our house. So that was an innovation, but it wasn't a great innovation because it didn't create high wage paying jobs. It created a bunch of lower wage paying jobs. The threat of AI that I think most people have overlooked is that it can replace, in theory. Now, whether it will or not is different. Again, that whole big rush we had for ChatGPT has kind of died down now. But all of a sudden you're talking about AI that can replace engineers and architects and lawyers and a variety of other journalists, screenwriters, etc. Those are low wage paying jobs. But there is a threat here from AI that it can actually start to reduce the labor requirements in higher wage paying areas, which isn't great for economic growth, right? So this productivity boost we may get by using artificial intelligence, yes, it will make companies more productive, but it will reduce the amount of labor that you need in some of these higher wage paying areas. Now, I'm not saying that's absolutely going to be the case because, again, the old argument is always, and this was the argument for the internet, is like, well, for every job that's lost, for whatever, they'll just go get a job programming computers. And back in 2000, I don't know if you remember this, Mike, but back in 1999, 2000, 2001, when I first started doing radio with Brent Clanton, we were talking about on the radio at the time, people were leaving their jobs to go be web developers, and they were getting Mercedes as a signing bonus and $100,000. If you knew how to program the web, people were paying you astronomical amounts of money to come be a web designer. And now that salary range is very low. Right? You don't see that anymore. And so this is going to be the same case with AI. There'll be this initial upshot where AI programmers will get paid a lot of money. Everybody will move into that job format. Everybody will want to become a programmer for AI. And you'll get a supply-demand imbalance of too many people wanting to be in that area for the demand, and wages will fall and salaries will fall. And that's just ultimately always the case of how it works because that's just the way the economies work over time. But again, when you start looking at the jobs that potentially displaces, that further weighs on this argument that productivity growth will be higher in the future. I suspect that it might actually be a little bit lower.
Yeah, I agree with you. Certain industries, sectors, certain people will be more productive. Mm-hmm. But again, as a whole, it's not just technology, it's debt, it's demographics. Yeah. And those are big headwinds.
Well, and they say if you want a stronger economy, have more babies. And that's the one thing that we're certainly not doing today. is the child birth rate continues to decline. All right, quick break. We're going to come back, wrap up the show. Where the market's going to from here, right? We'll talk a little bit about the markets, portfolio positioning, kind of what's happening, and we'll cover all that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. And good morning to our chat, everybody. There's about 410 people watching right now, so thank y'all for tuning in and watching the show. We appreciate it as always. Be sure and click the little bell icon to get notified, and make sure you're subscribed. We appreciate you subscribing to our channel as we continue to try to grow this thing slowly but surely. So markets this morning, so we talked about on Tuesday, we wrote an article talking about why we were kind of set up for a rally. And again, so, we have to go back to July. We were talking about the need that the market had gotten very extended. We had 5 months of gains, and, a bit of a correction was needed. And it's always interesting, right? It's always very interesting. So in July, I'm getting emails from people about why stocks can only go up, because I was talking kind of ad nauseum on the show saying, hey, look, we're due for a 3 to 5% correction. And I was getting emails from people like, we're not going to get a correction. It's only going to go higher from here because of A, B, C, D, E, right? Whatever. And then, of course, when we have the 5% correction, then I'm getting all these emails saying, well, the bull market's now over, the bear market's back, and this can only go down lower from here. The extremes always kind of tell you where you are, right? And when you start getting extreme views in one direction or the other, that's a really good indicator. And my email list is a great kind of indicator, contrarian indicator of where we are in the markets. So again, not surprising. We're kind of working on this rally, and the question is really kind of where do we go to from here? Now, one of the things to be aware of, though, is that this remains and has remained a very narrow rally, really, since the beginning of the year. There was a brief moment in June and July that we saw some rotation kind of into the other areas of the market. And Mike and I had talked a little bit previously about sector rotations and these type of things. And so for a moment, we did start to see, as an example, the S&P equal weight index saw some signs of life, and we actually saw some increases in the equal weight index, but that's mostly gone away now. And we're kind of really back to this mega cap driven passive flow of money into the markets, right? It's been Apple, Microsoft, Google, Amazon, Tesla, NVIDIA, really holding up the market and really kind of driving the market. And in fact, in last weekend's newsletter, we wrote that if you take a look at the sector breakdown between what's performing above or what's outperforming the market this year, which is technology, communications, and discretionary, and let's define those three, right? Technology, Apple and Microsoft. Discretionary, Amazon and Tesla. So communications is Google and Meta. So, again, those are the 7 stocks. Those are the ones really kind of driving the markets. And if you strip out those 3 indexes, right, just if you took those 3 sectors, if you take those 3 sectors out, everything else is performing far worse than the actual S&P 500. So instead of the S&P being up 15% for the year, we'd probably be only up maybe 1 or 2% for the year. That's the differential that's being created by these mega cap stocks within the overall index. And that's a tough fight to fight, right? I mean, being a value investor, being diversified in your portfolio, doing the right things that you should do in terms of managing risk has been really tough this year because you're not getting paid to manage risk. You're not being paid to be conservative. You're not being paid to be cautious. You're being paid to chase where the passive flows are pushing stocks. Because, remember, as we've talked about before, 30 cents of every dollar goes into those 10 stocks, right? So every time somebody buys an ETF, 30 cents of that goes into those top 10 stocks, and that continues to drive it. So this morning, people, yes, are buying NVIDIA stock, but they're also buying XLK. They're buying, ETFs that are replicating AI, whatever it is, and NVIDIA is the number one holding. So all that money is going to flow into NVIDIA this morning because of that report. So again, that's what makes it a challenge in managing money. And again, this is just what's happening now. This is an anomaly that we live in at the moment. It will change. But see, that's the challenge of investing, is navigating these periods where you have these anomalies in the markets that make it difficult to adhere to a strategy or discipline. And this is the thing that we talk about a lot here on the show. But again, on Tuesday, we were writing about, hey, we're going to be ready for a rally. So we're getting this rally. The question is, where does it go to from here? This is going to be the big challenge. And look, this could all change on Monday. If over the weekend, Jerome Powell comes out and says, you know what, we're going to hike rates to 6, it's going to be a problem for the markets. There is a very interesting dichotomy to the markets at the moment, which is what's happening with interest rates and technology stocks. Technology stocks are dependent on growth, economic growth. They're dependent on growth of earnings, growth of revenue. And if interest rates are high, right, that slows down economic growth, which would impact earnings. And so we look at technology stocks as what we call a long duration asset. They're overvalued, they're expensive, they're dependent upon growth of earnings to justify those valuations. NVIDIA, 40 times sales. You need a long time of very strong sales growth to justify buying 40 times price to sales today, right? That's just a function of the math. Interest rates deter that economic growth, which will deter that sales growth, right? So there should be a non-correlation basically between interest rates, higher interest rates, and tech stocks. In other words, if interest rates are high, technology stocks should be selling off. That's not been the case this year. And so the question to Mike is this time different, or is it just a delayed effect?
Maybe the technology investors are smarter than the bond market investors. Maybe they know that rates are going way back down and that this blip higher in rates is transitory. And that, again, if you're looking at a 10-year bond, or if you're looking at NVIDIA and you're looking at the next 30 years of sales, you can't really focus on the next 3 months or 6 months. You have to focus on that whole time period. And maybe technology, there's a lot of passive flows and but maybe some technology investors are saying, look, rates are going to be much lower. I'm not going to change all my models to make the 10-year rate for the next 10 years 4%, maybe for the next year. And then I have a feeling that rates will be lower. So, maybe they figured out something that the bond market still hasn't figured out yet. But you're right. I mean, a lot of this is passive and momentum, and investors are buying what's going up. They're buying those 7 stocks. And over the last week or two, we've kind of slowly slipped back into the Magnificent 7 are the ones that go up, and everything else just kind of lingers every day. And, the question we're facing now is that is that going to be the trend for the next month, 2, 3 months, or is this just a little blip around NVIDIA? And that, that's just something we'll see. And will Jerome Powell have an opinion on that? He may say rates are going to 6%. I think the risk that no one's talking about, and I don't suspect he'll say something, but it's possible that he says something about the stock market. The Fed has acknowledged that the stock market drives the economy, ergo it drives inflation. And the Fed has not said boo about the stock market in a couple of years. Yeah. So will they try to temper the stock market? Will they try to actually push stock prices down, or at least keep them where they're at, because it's another tool, in their opinion, not necessarily everyone's opinion, but their opinion, to limit economic activity. People feel richer when their stocks are up, they spend more. There's a lot of logic to their reasoning. Well, if stocks are down a little or if stocks are flat, maybe they won't feel as rich and they won't spend as much, and that will help them fight their war against inflation. So that's, it's not on, I don't think it's on anyone's radar. Something to kind of think about as Powell speaks. I think it's tomorrow morning.
It's tomorrow morning he speaks?
I think at 10 Eastern or 11 Eastern time.
So but it'll be very interesting because, again, to your point, he was making comments last year about the stock market and talking about valuations are rich, and he was and early last year in 2022, when they first started hiking interest rates, he had made several statements about valuations, and what you and I even talked about is that what he wanted was a controlled burn in asset prices to get prices lower, which occurred, right? We were down 25% at the trough last year. So we did kind of get this controlled burn of asset prices. But, what he was wanting was to drag that down, get consumer confidence down to quell this inflationary pressure. The question is he happy with the result, I guess? Is 3% inflation good enough, right? Because the one thing that he spoke about numerous times was not saying, I want inflation at 2%. He said, I want a clear trajectory of inflation back towards our 2% target, and which we clearly have. We've gone from 9 to 3, right? So there's a clear trajectory back to 2% at this point. And I guess the question for him is that good enough?
And I think no. And the reason I do is because he talks a lot about the 70s and early 80s, where inflation peaked in the double digits, came down to, whatever the prevailing rate was, 3-4%, popped back up. And this happened several times. And I think that he's scared to death that inflation isn't transitory, that it's not, that this episode of inflation is not. He's scared to death it's permanent, or that it's going to last a decade. And I think he really wants it down to 2%. He said as much. He's not happy that, he's thrilled that inflation's back to 3%. But every comment he's made is he wants it lower. And that's why he continues on this higher for longer and threatening to do more rate increases, because he wants it at 2 or, probably even below 2 for a period.
Yeah. It's all great until something breaks, though, right?
Which it will, but.
So, all right, that wraps up the show for today. Mike, thanks so much. Get by the website. Actually, this weekend's article is talking a little bit about, the risk to equities, which is higher interest rates and slowing economic growth, and why that's potentially problematic as we get into 2024. But again, that's all in the newsletter this weekend. So make sure you're subscribed for email delivery. We'll send it to you on Saturday morning when we get it done. Also, you get our weekly commentary as well on our Technical Tuesdays, our Macro Fridays. You'll have all the information you need. It's all at the website, of course, absolutely free. realinvestmentadvice.com. Send us your questions, comments, emails, and of course, yes, John, you should really start sending me more emails. Happy to talk to you. Anyway, all right, have a great day. See you next time.